everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the retirement advisors here with the Retirement Group, and we appreciate you, those folks here at ExxonMobil, joining us this afternoon. We hope to give you some value of spending a few minutes with us this afternoon. But before we get started, I want to cover a few things. First and foremost, we are not affiliated in any way with ExxonMobil, nor are we affiliated with Voya. And as it turns out, excuse me, as it turns out, our experience comes with all of the people that we have met with who are in situations similar to yours to help them transition into a successful retirement. And one of the many avenues of education we use in an effort to help people is this webinar platform. So hopefully you'll find it useful as far as time is concerned to hear what we have to say today. But you're also going to find some links into the chat to give you access to some of the things we've recorded in the past, which we encourage you to peruse at your own leisure, as well as a link in the chat to give you access to our ebooks library, which has a bunch of short to read topics that we get asked about, very common questions on a very regular basis. And so we encourage you to check those out also. But the thing you may find the most value of is spending a few minutes with us to take advantage of something we refer to as a cash flow analysis. Think of this as an effective stress test of your overall retirement goals and your investment objectives and your overall planning needs and future income and what retirement kind of looks like. And we encourage you, if you hadn't already done so, to do this because it's a complimentary service that we offer as a way to introduce our services to you. And so if you're willing to spend a few minutes with us, we're delighted to produce this document to you at no obligation of yours, of course. So last but not least, if you have questions about anything that we covered today or some things in general that you'd like to know more about, feel free to drop those questions into the question and answer box, and we'll do our very best to get to those at the end of the presentation. So without further ado, what I'd like to do is bring on today's speaker, Tyson, my partner, to talk about today's material. Tyson.
Thank you, Patrick. And thank you, folks, for attending our webinar series today. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the Retirement Group here in Texas. And what a wild year it has been here in 2022, not only for the oil and gas industry, but for our economy in general. We've seen some of the highest inflation numbers that we've seen in several decades. We've seen interest rates rise at a rate that we haven't seen in over 30 years. And we've seen a very difficult stock market with, of course, the exception of the oil and gas industry. There's many implications what this year has brought on the retirement plans of many of our clients and people that we talk to at ExxonMobil. Some good and some bad, but today we're going to focus on some of the issues with the benefits plans for those of you that are approaching your transition from ExxonMobil, whether or not that means you're actually going to be retiring. We have already seen many of our clients leave the company this year and are anticipating many more will be leaving in the not so distant future. So we're going to talk about some of the important considerations for those of you that are approaching your transition from the company. Patrick mentioned a little bit about our company. We've been around since the early 90s. Worked with corporate employees, not just ExxonMobil, but that's one of the companies whose employees we focus on and hope to continue to grow our business making clients from. A lot of different complementary services, even if you're not yet a client, we encourage you to take advantage of. Whether or not you already have an advisor, or maybe you're considering managing your finances on your own in retirement, we encourage you to take advantage of the webinar series, the ebooks library, the cash flow analysis, the net unrealized appreciation analysis for those of you that have ExxonMobil stock in your savings plan. And if you're not doing so yet, I encourage you to follow us on LinkedIn, as that's where we will reproduce our live webinars and have a whole series of different topics covering investment strategies for retirement, estate planning strategies, tax strategies for retirees, the ExxonMobil benefits plans, and generic retirement planning and distribution strategies that we find has a lot of value for even folks that don't work at ExxonMobil, but especially for those of you that are either recently retired from ExxonMobil or are approaching your retirement from the company. Now, we're going to focus on the benefits plans today, but it's very important when we run this cash flow analysis, we incorporate all of the sources of income and be as efficient as possible with each of these sources, because each one works together. It should be working together effectively. What I mean by that is, depending on what you have in your 401k plan, that might encourage you to go one way or another on how you take your pension, whether as a lump sum, an annuity, or a combination of both. Whether or not you have a spouse and whether or not he or she works and has retirement benefits also may be affecting how you take your pension or the timing of your retirement. And it's critical that we put all this into a plan that is allowing us to look at every moving part in the plan, every different income source, every investment that you have and bucket of money, the tax bracket status, your goals as far as producing income, as well as maybe helping people through retirement and maybe after you pass away. All of this needs to be considered in conjunction with one another so that we can be efficient with our decision making on the timing of different decisions, and also how we invest money once you leave the company and need to reproduce an income stream after your paycheck stops from ExxonMobil. Now, the lump sum has been a very popular option, especially lately, for employees to take on their pension, but it's not the only option, and it's critical that you understand the various options that you have on taking your pension. I had a conversation with a gentleman yesterday where there was some uncertainty on how the extended period certain option works. And it's critical that you understand how some of these work, because this is an irrevocable decision and the lump sum might not be the most appropriate option for you, or at least the full lump sum might not be the most appropriate option. And the more you educate yourself, I think the better you're going to be able to make this decision, but also the lower the probability of you having regret sometime in the future. And of course, nobody knows how long we're going to live or how productive or what our average rate of return is going to be on our investments. There's a lot of variables on what's going to ultimately give you the most money throughout your life. And some guesswork needs to be done, but understanding how these options work will allow you to whittle this decision down a lot better. And like I mentioned, the full lump sum, while even though interest rates have gone up, it's still a great option for a variety of reasons. It's not the best option for everybody. So here's some of the other options. We have the single life annuity, also a life with 5 years certain, specifically as they call it on your pension projections. You have a joint and survivor annuity, a variety of different ways that you can take that to have income for not just your lifetime, but your spouse's lifetime, or maybe somebody that's not even your spouse, 2 lifetimes specifically. And then you have what's called an extended period certain, wherein it's a single life annuity. It's payable for your entire life, but also has a death benefit associated with it if you pass away within a given period of time, 10, 15, or 20 years. The longer period certain you choose, the lower your single life annuity is going to be during your lifetime. So it's effectively like buying insurance using some of your pension annuity to do it. So again, spend some time with us or with whoever you're working with on some of these decisions to understand the options and also the pros and cons of different decisions related to your pension distribution option. Now, it used to be that Termini only had annuity options, but within the last 2 years, they have created a one-time only lump sum option, even if you haven't met retiree status, which is 55 years of age with at least 15 years of service. Once you hit both of those milestones, you will be considered a retiree as opposed to a terminee, and your pension options grow, as well as some other benefits that become available once you reach that milestone, including health insurance as well as some life insurance benefits. But there are some instances, especially lately, that we've seen people either volunteering to leave prior to retiree status or having to leave the company, whether it's because of a performance improvement plan or some type of reduction in force that has been done in the last several years with the challenges that the industry has faced. But in most cases, the ideal scenario is to at least meet 55 and 15 as a benchmark. And then beyond that, it might make sense to continue working, but in a rising interest rate environment, it might actually make sense to accelerate your retirement date. In other words, retire earlier than you expected and actually have more money to do it because you saved some money on your lump sum. And we'll talk about how that works with the interest rates in a few slides here. Now, the ExxonMobil pension is what they call a defined benefit pension or a formula-based pension. These pensions are quite rare these days, as many companies have switched to defined contribution pensions or no pension at all, and the onus being mostly on the employee to save for their retirement, but still a very, very good pension, one of the better pension plans in the United States. And although it's not critical that you memorize this formula, there are a couple important considerations on this formula. So let's go through it. First of all, you have to have at least 5 years of service or be 65 to get some kind of a pension, or what they call to be vested in your pension. Now, the formulas, what they're going to do is take 1.6% of your final average earnings, final average pay, and then multiply that by your years of service with the company, including months, right? It's the prorated amount. They're going to subtract off something called a Social Security offset, and that's going to equate to an annual annuity. Or if you take the single life annuity, what you would get paid to you for the rest of your life. Now, from that pension option, they will use interest rates as well as your life expectancy and potentially the life expectancy of your joint annuitant to calculate all of the other pension options. Now, the final average pay, it's important to note, this is the highest 36 consecutive months within your last 10 years of the company. For most people, just the average salary for your last 3 years of the company, but not always the case, especially if you had some foreign service or if you had varying pay throughout your retirement or throughout your career rather. And good reason if you're still enjoying your job and making good money, not just from a salary perspective, but it might make sense to continue working from a pension perspective if you're at the higher end of your earnings. Now, something that's also important to mention is that there's age penalties on the plan. And it's also important to consider if you do not leave the company on or after your 60th birthday, and otherwise, if you retire prior to age 60, you might want to consider waiting to take your pension. The reason being, your pension is still going to grow, both the lump sum and the annuity options, based on you aging out of these penalties. And if you're a terminee, you especially want to consider this because the age penalties are even deeper or even bigger when you leave prior to age 65 in the case of a terminee. Let's talk about these age penalties for a moment. I'm going to try to zoom in on this a little bit, smaller slide. You can see that on the top here, we have the age penalties for a retiree. So somebody who leaves the company, they have 15 years of service at least, and they're at least 55. You can take your pension as soon as 55, but you're going to get a 25% discount. Now, oftentimes when we tell this to our clients, they say, well, why on earth would I want to take a discount? I'm definitely going to wait 5 years to take my pension, then just get 100% at age 60. Why not if it's a effectively guaranteed growth rate on my pension? Well, the reason you might not want to do that is really twofold. One is because if interest rates are going up, your lump sum option on your pension is going to be going down, perhaps at a rate that's even greater than 5% a year. Like in this year, for instance, we saw some people losing 20 to 25% on their lump sum in less than a year, in which case that 5% growth wasn't all that attractive to wait to take the pension. Another reason you might want to consider taking your pension sooner, even if you aren't yet 60 when you leave the company, is to have the ability to invest that money sooner. So for instance, if you were somebody, and of course, there's no investments today that I'm aware of, at least, that'll guarantee you 5% on your money. However, there are investments that would probably, without a guarantee, potentially average you a higher rate of return than 5% a year. So while ExxonMobil, by leaving your pension there, your pension could be growing by 5% a year, it could potentially be growing by a higher rate outside of the pension. So there's an opportunity cost, in other words, for leaving the money there, and that is whatever rate of return you're able to receive on that money invested outside of the pension plan. So not an obvious decision for everybody, but our recommendation is to evaluate this on a quarter-by-quarter basis after you leave the company. If you leave prior to age 60, you want to be looking at this every 3 months to see what are the interest rates doing and what are my alternative investments that are available to me. Of course, we can't predict certainly what the stock market's going to do in the short run. And your risk tolerance is also a factor here. But if you feel like you find some good bargains, some good investments that have some good long-term growth prospects, that would also potentially be a consideration for taking your pension as quickly as you can after you leave the company. And from the annuity perspective, you may want to take that sooner as well, depending on whether or not you need the income, and also just to start the paychecks coming sooner. But then we get into life expectancy when we're evaluating that timing issue. On the table in the bottom right of this slide, this is the age penalty schedule for somebody who leaves on disability. And you could take your pension as soon as age 50, although you can see the discount is even greater. You're only going to walk away with half of your pension if you leave and take your pension as early as age 50. Now, probably the biggest takeaway from today's material is what's happening with the interest rates and how does that affect your lump sum. So let's zoom in on this table. So what we're looking at here on top of this table are the interest rates that were just recently published for September and that were published a month ago for the month of August. These 2 months, when averaged together, create what we call the Q1 2023 blended rates. They take the average of the first, second, and third segment rates, which, by the way, are correlated to short, intermediate, and long-term corporate bonds, and affect your pension differently. As it turns out, the second segment rate carries by far the most weight on your pension lump sum calculation compared to the first and third segment rate. So that's the one that we pay the closest attention to. But what you can see, what has happened, looking down the table a little bit, to interest rates. If you go all the way back to Q1 of 2022, people who retired and took their pension were getting a rate of 2.53 on the second segment rate on their lump sum, compared to those who wait until the first quarter of next year to take their pension. The second segment rate is 4.94. That is almost 2.5% higher than where it was 1 year prior, which in layman's terms means roughly about a 25% drop on your lump sum just because of what has happened to the interest rates. Now, you probably made a little bit of money because you worked that extra year, but for most people, they lost more money than they made as a result of the interest rates going up. Then, of course, you factor in your salary. Most people that we talk to are slightly better off because they worked this year, but effectively you are working for less potentially because you were losing money in your pension, even though you were making money in your salary. So you can see there's a lot of moving parts here. And what we're trying to do is optimize the timing of our retirement to walk away with the most money possible and give ourselves the highest probability of success in retirement possible. So pay close attention to this, folks, or if you don't want to, just make sure that you're checking in with us at least on a quarterly basis, whether it's through these webinars or in a short conversation, or like we mentioned earlier, the cash flow analysis is a complimentary service that we offer even to those of you that aren't yet clients of ours. Update that at least annually is our best recommendation based on how often these things change, how many issues are changing on a constant basis, tax issues, the interest rates, the stock market, and some of the rules on what applies to us in our retirement accounts after we leave the company. That's why we recommend updating your cash flow analysis at least annually. And if you haven't done one yet, there's no excuse not to do it because it's a complimentary service. It usually only takes about 30 minutes for us to put it together and another 30 minutes to review it on a web meeting or an in-person meeting. Unfortunately, statistically, 74% of Americans do not have a written plan for their retirement. So don't be one of the statistics here. This is probably the most, think of it, this is the most important vacation of your life. It's going to be the longest vacation of your life, your retirement will be. So spend at least as much time planning for your retirement as you do on your vacation. Something else that we don't have a slide on, but two topics that I've ran into recently with people that I've talked to are issues related to IRS 415 limits on how much of your pension you can roll over either to your 401k or your IRA. Some tax issues we want to talk to you about when we go through your cash flow analysis, especially if you have a supplemental pension. That's what we're referring to specifically. And with regards to the Social Security offset, if you haven't done this yet, it's important to figure out whether or not the company has accurately calculated your Social Security offset, because they could be undercutting you or shortchanging you on your pension payout by misrepresenting your Social Security benefit or miscalculating what your projected age 62 Social Security benefit is. So when we go through your numbers, we'll go through this with you to help you evaluate whether or not you should turn in your Social Security statement. And just to give you an example, we helped one of our clients save, it was about $32,000 on their lump sum. In other words, they got a lump sum check that was about $32,000 more because they proved to the company that they were getting this calculation wrong. So pay close attention to some of these issues. It's real money and it's potentially can make or break the success of your retirement. So let us know how we can help. You can email us at info@theretirementgroup.com, any specific questions or to schedule a meeting. Call us at the home office, 800-900-5867. You can even take a picture of this QR code, go to the website to schedule a meeting with one of our ExxonMobil focused advisors. And again, there's that LinkedIn QR code to follow us so that you're making sure you don't miss any up-to-date content related to the ExxonMobil retirement strategies. With that, we're going to wrap it up for today, although we do have some time for questions. So Patrick, I'm going to pass it back to you for any questions that came up or any last minute housekeeping issues that you have for us.
Yeah, thanks, Tyson. We do have a number of questions, so let's get to it. I am retiring next year and considering taking the annuity payment. The question is it better to take the ExxonMobil annuity or to take the lump sum and purchase my own annuity with my lump sum?
Great question. Not an easy one to answer for a variety of reasons. There's hundreds of different, first of all, insurers that will offer these, as well as types of annuities. There's income related annuities, which are the most consistent with the pension option you have from ExxonMobil, although they also have differences, such as the ability to pull from that money quicker, have cash value, and a death benefit. With interest rates having gone up as quickly as they have this year, this is the first time in I think in my entire career with the company, which is I think going on 12 years now, where there's actually some cases that we've seen where the insurance companies will actually pay more than ExxonMobil, given how much the lump sums have dropped on a quarter by quarter basis. In other words, there's an arbitrage opportunity here potentially, depending on how much your lump sum is, your age, if there's a spouse involved, and those type of things. There's a lot of variables there. There's also other types of annuities that aren't really correlated or aren't much like the annuity option on your pension, wherein rather than trying to guarantee a lifetime or certain period of income, you're trying just to protect your principal while still having some growth potential. We've used those as bond alternatives in the past. And that might be something to consider in a rising interest rate environment, the detriment and risk there is to bonds. But there's hundreds, if not thousands, of these types of investments. So I guess my best answer is maybe we need to run your numbers and figure out what's important to you. Is it legacy planning? Is it maximizing your income? Is it inflation hedge? Longevity risk? There's all sorts of issues here. So it's not usually an apples to apples comparison. We need to understand a little bit more about you and your situation to say for sure.
Yeah, here's a good question that's related to this potential supplemental pension plan. And maybe we could just talk for just a second about how this works and why this is a taxable event and may play a big role or a part in your decision to retire.
Sure. So this doesn't affect everybody. It's for what the IRS considers highly compensated employees. If you make too much money or did during the years that they were using to calculate your lump sum, part of your lump sum is going to be paid as what they call a supplemental pension plan. That's what they call it at ExxonMobil. The IRS calls this 415 excess, technically. And even if you don't take the lump sum, you're still going to have this, even if you take the annuity. So on your pension projection, you'll know that you have this because it's toward the bottom of the pension projection. And this amount is payable the day after you retire from the company as a lump sum. And this is also taxable income. The reason this is significant is because it may actually change when is the optimal retirement date so that you can be more tax efficient with your income. For instance, if you retire as a non-grandfathered employee, which means you have to retire by November 30th and commence your benefit in December 1st to have a fourth quarter commencement date and therefore have the fourth quarter interest rates to calculate your lump sum. Well, if you have a supplemental pension, you're going to have, I have one client that had a over $900,000 supplemental pension plan, which means that income was taxable the year he retired. And one of the things I recommended to him, even though the interest rates were going up slightly in the first quarter compared to the fourth quarter, so he's going to lose a little bit of money on his lump sum, he was going to lose a lot more money in paying higher taxes on his supplemental pension by taking that money in the same year that he already had 11 months worth of income. So we recommended he retire in the first quarter. He also got to take his vacation pay as a result of retiring in the first quarter. And that supplemental pension was taxed at a lower effective tax rate because he didn't have as much income. In other words, he spread the income out over 2 tax years rather than all in 1 tax year. So some timing issues there. Great question. It doesn't affect everybody, but that's another reason it's important to work with somebody who understands your ExxonMobil benefits to make sure that you're not overpaying in taxes when you leave the company.
Okay. Another question about the pension formula and specifically the relationship of the offset of the Social Security benefits, because it appears to this individual that their Social Security estimate or payment looks low. And the question is, will this hurt my pension?
If on the Social Security, or excuse me, on the pension projection, if your Social Security benefit looks low, that's probably something you don't want to tell the company about, because they're going to be offsetting your pension by a lower amount, which actually benefits you. It's still good to do the evaluation to make sure that you're not looking at it wrong. And you do that by comparing your Social Security projection from the Social Security website to the what they call the Social Security offset amount on your pension projection that you can create through the EDA website, or you can go directly through the benefits website if you have your PIN number. We'll help you with this, by the way, if you've never done it. And if they're overestimating your Social Security benefit, whether that's, if you're under 62, they're going to use your projected age 62 benefit amount. If you're still working past the age of 62, they're actually going to use your projected Social Security amount at the age at which you're retiring, which is another reason why it starts to hurt people to work past 62, other than the life expectancy component of the lump sum calculation. So you have to do an accurate comparison on this. You don't want to get it wrong, because if you turn in your statement and the company was wrong, but it was benefiting the company to fix this, they're going to still fix it, and you might actually hurt yourself by turning in your statement. So let us know if you'd like to spend a few minutes, and we're happy to help you make that evaluation, whether or not you should turn in your statement when you retire.
Okay, we have a question from a grandfathered employee, and the question is, how will the lump sum be impacted by the interest rates? Because I believe that's a different rate that applies to me versus what applies to the normal ExxonMobil retiree.
Yeah, sure. So we didn't go into too much detail on this. The non-grandfathered rates, which is pretty much everybody these days, I would say probably 98% of the ExxonMobil community these days, those are going up by a little bit more than 0.2% in the first quarter. So most non-grandfathered employees are going to lose probably a small amount of money on their lump sum if they work into the first quarter or don't commence their benefit until the first quarter. For the grandfathered folks, that rate actually didn't change. It stayed at 3% flat. So you'd be indifferent from a pension perspective. And for those of you that weren't ready to leave, you may want to consider working at least until the end of the first quarter, not only to maximize the amount of paychecks you can get, but also get your vacation pay and maybe not have to retire during the holidays, which can also be stressful, I found.
Yeah, a follow-up to that, by the way, Tyson, is when is the last day someone can leave and take advantage of the rate, the current quarterly rate?
Good question. Also a function of whether or not you're grandfathered. If you are not grandfathered, so that's XTO employees, any employee who is not, I have to make sure I get the math right on this, 65 years old with 25 years of service by the end of this year. You have to meet both those milestones to be considered grandfathered. And if you had a break in service, then you probably won't be grandfathered if you left the company and came back. For the non-grandfathered employees, you have to leave by November 30th, commence your pension December 1st to get the more favorable fourth quarter interest rates. If you left in December, for instance, the next available commencement date would be January 1st, which would put you out into the first quarter. For grandfathered employees, that's not the case. You can work all the way up to the end of the year, get the fourth quarter interest rate, and if you do the timing correctly, if you work at the last day of the year, commence your benefit on the first day of the year next year, you can actually get your vacation pay too and get the more favorable fourth quarter interest rate. So a couple timing issues there, but it just depends on how long you've been at the company and whether or not you're grandfathered.
Okay, here's a question about the decision of the pension itself after they retire. So do I have to take my lump sum pension right after retirement? And if I wait to commence my benefit, will I then be forced to use the following quarter's interest rate, or can I defer that?
Yeah, great question. So you can defer the election of your pension. We talked a little bit about that, which sometimes makes sense, especially for those that are not yet age 60 or who are terminees that aren't yet age 65. Because that's when the pension maxes out for terminees is age 65. The normal retirement date is age 65. The significance of that is you have to take your pension shortly after if you retire from the company after age 65. You'd probably want to do that anyway, unless we knew that interest rates were going down and your lump sum was going up. That might be a reason that we'd want to defer the election of a pension, even for those folks that are over the age of 60. But you're still subject to interest rate risk at that time. That's why I said evaluate this on a quarter by quarter basis, because even though you may be aging out of some penalties, or for some folks that didn't work with an advisor prior to retirement are still trying to figure out who they want to help them and where to send this money, Charles Schwab, if you work with us, of course, and then also how to invest that money. I've seen that be a sort of sticking point for people that they're just not ready to tell the company where to send their money. Keep in mind, you can always send the lump sum to your 401k if you want to park it there for a short period while you figure out some of these decisions. But then there's a whole nother conversation on the benefits and detriments of the 401k compared to an IRA that we would want to talk to you about. But the answer is yes, you can defer your pension election after you retire, but be careful in doing so based on the moving parts that go into that decision.
Okay, just two more questions. This is a pretty good one given the economic condition and where the market's at, that we've been getting asked recently for sure, which is, what's the probability of ExxonMobil canceling the lump sum option and only providing the annuity payment? And actually, are they allowed or can they do that?
The answer is yes, they can do that. The probability of this situation, I'm not going to speculate on. I've been getting this question a lot actually lately. And I got it, I would say, more back when the stock was at $30 a share and oil went negative price back 2 years ago, 2.5 years ago. They could also be forced to do this, by the way, as you know, Patrick, with the Pension Protection Act. ERISA laws fortunately protect your pension plan, meaning the company has to pay you the pension as long as they are solvent, as long as they're not in a bankruptcy situation. However, if the funding levels ever drop to a certain point, I believe it's below 80%, they could be forced to either take away the lump sum option by the government or only offer a partial lump sum, like we've seen with some companies in the past. So who knows what the probability is? I'm going to say that's probably not that likely today, especially given that I've had some clients that were annuitants that were offered lump sum options where the company actually came back to them and said, we know that you're taking annuity, but if you'd like to take a lump sum, we'll buy you out of your annuity. That's actually happened to one of my clients earlier this year. That tells me that the company would prefer to reduce the liabilities that they have as to the annuity recipients and the retirees, rather than not offer a lump sum. But if anything, I think it would be more likely that the government, if they had funding issues, which they do not currently, if they had some funding issues, I think it's more likely they'd be forced to either have only a partial or no lump sum at some point in the future. But certainly a risk of continuing to work is the possibility that the options could change, just like they changed in our favor about 7 years ago when they offered the hybrid option to take a partial lump sum with a partial annuity. The opposite could absolutely happen at any point in the future.
Yeah. Okay, last question before we wrap it up. I'm aware of the current interest rate environment, but I do not want to retire until 2024 when my kids get out of college. I'm currently 62 years old and I'm staying because I feel like no one will pay me what I currently earn at ExxonMobil if I decided to leave and go somewhere else. And so the question is, are we suggesting that it may make some sense to leave in a given quarter where interest rates are rising and get a lower paying job to try to maximize the pool of capital that we have?
Maybe. I actually have a client that left this summer with a very similar situation. Hadn't planned on retiring for a couple more years. We actually found out they did not need to work and were still actually better off by leaving because of the amount of money they saved on their lump sum. But then I also have some other clients that, because the interest rate increase is not as large from fourth quarter this year to first quarter next year, that we ran the numbers, and in their particular case, they could take a job that pays them half as much as what they're making now from ExxonMobil and still be better off financially when we incorporate every aspect of their plan. So best advice, just run the numbers, run a cash flow analysis and see really where you stand today, first and foremost, but then also what are some other scenarios of you leaving the company at different times. And in a rising interest rate environment, we've seen this make sense in many cases. Leave earlier, either don't even work and still have a better situation, or work and take a pay cut, and maybe even take a benefit cut. I've had a lot of clients work part-time as consultants or doing some contract work. And I really like that plan just because it's an easier, smoother transition into the retiree schedule, which is, I think, psychologically healthy to do anyway, even if the finances are exactly the same, whether you stay or leave. So run the numbers, I guess, is my best advice, and we're delighted to spend some time and help you evaluate that.
Yeah, that would be my takeaway here, is just make sure that you analyze and cover as many situations as might be possible, or more importantly, to consider, right? You might leave the payroll, but you might need to work, but you might not need to be compensated as much as you're getting currently compensated at ExxonMobil, and that'd be a way among many to maximize your capital. And as Tyson mentioned, reality is you just need to do some planning, and we're delighted to do so because it's a complimentary service that we offer. And if you want to spend some time with us, please reach out to us. You can call us at 800-900-5867, or if we didn't get your questions answered today, you could email us at info@theretirementgroup.com. So with that said, we appreciate your attention this afternoon. We hope you found some value in spending some time with us today for sure. And until next time, everyone stay safe, and we'll see you.
Thank you, folks.